Welcome to Discovering the Vegas Real Estate Market with Jason Tomei, delivering knowledge, expertise, and trust.
What is a buy down? Well, mortgage rates have doubled in the last year. That's why everybody's talking about a 3-2-1 buy down and a 2-1 buy down these days. These are best thought of as a temporary rate buy down, whereas buying traditional points are permanent rate buy downs. How do they work? Well, I'm glad you asked. In a 2-1 buy down mortgage, the interest rate in the first year is 2% points lower than the base rate. In the example here to my left, that's 7 minus 2% equals 5%. In the second year, the interest rate is 1% lower than the base rate, so 7% minus 1% gives you 6%. And then in the third year, the interest rate moves to the base rate and stays there. In a 3-2-1 buy down mortgage, the interest rate in the first year is 3 percentage points lower than the base rate. In this example, that's 7% minus 3% gives you 4% for the first year. In the second year, the interest rate is 2% lower than the base rate, so 5%. And then, of course, in the third year, the interest rate is 1% lower, so that gives you a 6% rate. And then in the fourth year and the rest of your loan period, the interest rate moves back to the base rate and stays there. The benefits of these loans are fairly obvious. A lower interest rate in the first few years, but without the higher cost of buying down the rates permanently. And unlike an adjustable rate mortgage, the buyer knows the future interest rates they will pay with certainty. The risk of these loans are mostly related to budgeting. For example, on a $400,000 loan, a 3-2-1 buy down loan with a permanent rate of 7%, the monthly payment might start off at around $1,900 a month, rise to about $2,150 a month the second year, and then up to around $2,400 in the third year. And then in the fourth year, up to a little over $2,600 a month, and that would be for the remaining years. In other words, the monthly payment will have increased by 39% from year 1 to year 4. Perhaps the buyer's income will have increased over that time period too. But what if it doesn't? Maybe more importantly, sellers, including new home builders, can pay for these temporary buy downs to make purchases more affordable to buyers. You should absolutely discuss this option with a loan officer or a mortgage broker. If you don't have anyone in mind, let me know. I can always refer you to one.
Thank you for watching. Please be sure to like and subscribe and share this video to your favorite social media platforms.